Correlated markets, or markets that tend to move together, can offer some great trading opportunities. Our guest today, Tony Hansen, is here to talk about that. So Tony, what correlated markets do you like to trade?
Well, what's been really popular lately is the commodity and the currency pairs. And we see a lot of situations where these pairs, a lot of these currency pairs will be really tightly correlated to things like oil and gold in particular. So when you're looking at commodity and currency pairs and how they correlate, some of the big ones to watch would be like the Australian dollar, the Canadian dollar. Australia, of course, is very tied to gold. And the New Zealand dollar is very closely tied to the Australian dollar. So you'll often see both of those have a strong correlation to what's going on in the gold market, because Australia is one of the top producers in gold. And alternately, we have the Canadian dollar is also another one of those where we see a lot of correlation to the commodities. In this case, it's oil, because it's one of the top places where you'll find oil. They say that it has, they believe it's the second largest reserve behind Saudi Arabia, and it tends to be 9th and 10th in terms of oil production and exporting. And so a lot of times you'll see really strong correlations between these. But when you're looking at trading them, you have to look for the divergences, and when you're starting to see one of them begin to lead and one of them begin to lag. Like sometimes you will have the Australian dollar will be leading gold slightly, and that can last for a number of months. But then they'll start to come into alignment, and then it'll begin to lag. And so you can use these periods of where it is being a leader to kind of develop a strategy for what's going to happen in gold, and follow that. And a lot of times what I use is that I will look for like reversal patterns in one of the particular ones, like such as the leading security. And when I have that reversal pattern in that, oftentimes you will find that you'll then get the reversal following in the lagging one. And so if you miss a strong signal in one of them, you have a chance to pick it up in the other one. And there's also times where you'll have them correlating, but one of them will be stronger than the other. And so you'll have something that both of them might be heading lower, but one of them forms a stronger reversal pattern than the other. And as they do so, sometimes the one that is slower can actually gain momentum stronger than the one that starts heading up higher first. So it kind of gets flushed out a little bit more, you could say. And so when it's slower and taking more time and kind of just ticking lower and lower, a lot of times, even though the other one had turned higher, the one that was ticking lower will have the stronger reversal. And so it offers a really good trading opportunity. So those are some of the things that I look for. If
you can catch it early enough, would you suggest shorting one and going long the other until they come back together?
Usually I don't, because it can be a little bit unpredictable how long those divergences are going to last. Sometimes they can last a couple days, sometimes they can last a couple weeks. I mean, we've seen a little bit more of decoupling over the last couple of weeks, for example, and you don't want to be too aggressive in terms of like the hedging, because a lot of times I find that one will just go flat. I mean, I'm not too much of a big hedger, so I like to be in the one that I think has the strongest possibility. I mean, if you are into hedging, that is something that you could look at, but personally it's not something that I do. So
Tony, thanks for your time.
You're welcome.
You're watching the MoneyShow.com video network.